Well, let's start with the currency market action, and we saw a flight to safety to the US dollar, which is hurting currencies around the world. The rupee weakening today, hitting a new all-time low again as it plunged in trade. One US dollar now costs 81 rupees and 62 paise. In the bond market, India's 10-year benchmark bond yield also spiked as the US yield hit multi-year highs. Lata joins us now to wrap up the money market action for us. Lata, 81.62, that's the dollar rupee for you. Where are we headed?
Well, this is all global chaos. So over the weekend, the pound plunged so much that you saw fresh highs in the dollar, 114, and US yields, as you said, spiking to almost 3.79, and the two-year US Treasury spiking to 4.2 or even higher. So, the typical reaction is, when I get a risk-free return of 4.2 in a two-year Treasury, why should I be staying in EM currencies where, I will even lose the principal on currency depreciation? So we saw in the NDF market overnight a plunge, and all Asian currencies were nearly 1% lower in morning trade. This was just an arithmetic trade in the morning done by hedge funds who operate, in the NDF market and across countries. It isn't as if actual clients like, oil companies came and bought dollars thinking that it will be 82 tomorrow, or, exporters refused to sell. It's not, or that equity traders sold. It was not a real economy play as much as traders correcting positions, covering any short dollar positions. But now all eyes will be on the Reserve Bank. What is the whole number that it is trying to protect? The Reserve Bank in turn will watch whether there are actual outflows. But now that the whole number 80 is gone and the whole number 81 is gone, there is a bit of a catching of the breath between 81.50 and 82. People will watch, but if global cataclysmic moves happen in the financial market, even this will pass. Everyone is waiting to see where there is a bit of a catching of the breath and a feeling that enough is enough. In the bond markets, yes, yields have spiked, and that's obviously led by US yields, in spite of the fact that we have an advantage with crude really crashing. People are only looking at the way US yields are surging. The bond markets are now actually already factored in a 50 bips hike. Our own Citizens MPC has voted 4:1 in favor of a 50 basis hike. So it is already in the price. If you looked at the OIS, the overnight index swaps market, which is really the most active, reactive market, that has priced in something like 6.9% 1 year down the line, which means they believe that if the Fed goes to 4.5 and 4.75, then India's peak rate also has to be 6.75 or even higher. So a lot is already priced in, but just as a matter of detail, today only the 10-year bond by end of trade, actually the yields fell a little, because looks like, foreign banks are seriously short and they actually had to cover. But otherwise, yields are on the upswing.
All right, Lata, many thanks for joining us to take us through what's happening in the money market. And as Lata was mentioning, the rupee is not alone. The British pound also weakening to a record low versus the dollar overnight after the new government announced tax cuts despite fears of a recession. Meanwhile, the euro has also touched a two-decade low. The Australian dollar has hit multi-year lows, and the Chinese yuan fell to the weakest level in 28 months. Other Asian currencies like Japan's yen and South Korea's won also weakening today. And from the currency markets to the stock markets, it was a sea of red across the world, and our markets were no different today. The Sensex and the Nifty falling to the lowest level that we've seen in 2 months, and the fall was led by financial stocks. But the sell-off that we saw today was broad-based, even though we did see a little bit of recovery coming in today. Mid-caps have seen sharper cuts in the blue chips. About 11 lakh crore rupees worth of investor wealth was wiped out in the last 2 trading sessions. That's the market action for you. And in the commodity markets, oil prices in the red for the second straight day, with Brent trading below $86 a barrel as fears of demand destruction and a surging dollar have impacted buyer sentiment. Crude remains under pressure even as OPEC Plus producers say they may curb output to support prices, but 85, that's where Brent finds itself almost at an 8-month low. In fact, falling crude oil prices may bring some relief to Indian oil companies. The Revenue Secretary Tarun Bajaj said that the government will review the windfall gains tax at the end of the month. That's as part of the fortnightly review, which is underway. He also made it clear that any decision on whether the tax will be done away with altogether will depend on incoming crude data. Take a look.
तो फर्स्ट का तो है 30th को या फर्स्ट को आने तो दो डेटा अगर कम होगा तो कर देंगे कर तो रहे हैं आर क्रेडिबिलिटी इज इन द फैक्ट दैट वी हैव रिड्यूस्ड द टैक्सेस व्हेनेवर द प्राइसेस हैव गॉन डाउन
So that's the Revenue Secretary. Remember, the fortnightly review of the windfall gains tax will take place on the 30th, but whether the government is likely to do away with the tax altogether or it will wait to see the trend line as far as crude prices are concerned, that is the big question. The GST Intelligence Unit has issued a show cause notice to Bengaluru-based online gaming startup Gamescraft Technology. The company has been accused of not paying GST the tune of 21,000 crore rupees. Now, this is the biggest show cause notice in the history of indirect taxation. However, the company says authorities are claiming dues on the basis of 28% applicable tax to the games of chance and lottery instead of the 18% applicable to online platforms of games of skill. Remember, the group of ministers who were supposed to submit their recommendations on how the tax should be levied on gaming has not yet presented its report. Now, the GST kitty remains strong. Sources say GST collections for August are likely to be in the range of 1.47 lakh crores to 1.5 lakh crores. The growth in collections is likely to come on the back of higher festival buying and healthy sales in Tier 2 cities. And staying with the festive sentiment, India Inc. is pinning its hopes on demand pickup as the festive season kicks in. Axis Bank's Amitabh Chaudhary says festivities can change the mood across rural and semi-urban markets. Girish Bagh of Tata Motors also is upbeat, expects sales growth to hit double digits this year.
A lot of people are looking forward to this festive season coming up, which has already started, and the evidence which we are seeing, especially for the right products, right brands, is huge. I think Indian consumer is looking for that right value proposition, and if it is offered to them, they grab it. So I do expect that in the festive season things will pick up. Obviously, the rural and the semi-urban demand is a bit muted. Hopefully, this will help revive the demand and take it forward.
But I'm also curious in terms of what the future would look like from a festive season perspective. We are of course entering what is most likely to be the promising period in terms of sales. But even though there are undercurrents of a slowdown, there is talk of global recession. Would these weigh in on the kind of projections you've set for yourselves in the near to medium term?
So that's right. I think the commercial vehicle industry volumes are always a function of how the headwinds and tailwinds act with each other, right? So we do have headwinds in terms of the interest rate growing up and the fuel prices. But it appears that the fuel prices seems to be stabilizing, so that's one good news. As far as the interest rate is concerned, I think we are watching the impact. But if you look at the tailwinds, I think whether it is increasing consumption, government's focus on infrastructure, I think that is leading to tailwind being more than headwind. And therefore, I think the sentiments are better and we see growth happening even in this year. Of course, FY19 was our peak. From there, we had dropped by almost 50% in FY21. Over that low base, I think we grew by 26% last year. In my view, we should be growing in double digits even this year.
While India Inc. hoping that the festive season delivers on demand. We will head into a break, but up next, employees across the country expect to get a low double-digit salary hike next year. That's according to a survey by global professional services firm Aon. A special discussion when we return. Welcome back. You're watching Business 360. Employees across the country expect to get low double-digit salary hikes next year. That's according to a survey by global professional services firm Aon. Indian employees are expected to get a salary hike of 10.4% in 2023 as compared with 10.6% in 2022. The survey was conducted in August. India reported single-digit salary increase of 9.3% in 2019, falling to 6.1% in 2020 and 9.3% in 2021. With an expected salary increase of 12.8%, e-commerce is expected to see the highest salary hikes, followed by startups at 12.7%, high-tech information technology and IT-enabled services at 11.3%, and financial institutions at 10.7%. To discuss more about the findings of the survey, we're joined by Jung Bahadur Singh, Director of Aon Human Capital Solutions. Mr. Singh, many thanks for joining us here on CNBC-TV18. I want to understand from you what the downside risk is to these projections that have been put out by Aon. This, of course, is based on a survey that you have conducted. But at this point in time, the global environment is clearly deteriorating, and the impact of that that and the fallout of that on India is being carefully assessed and watched for now. So could this picture look very different a couple of months down the line?
Thanks, Shane, for having me on the show. Pleasure to be here. I think you've rightly articulated that we are in a world today where there are a fair amount of headwinds at play. If we look at what's happening from a volatility standpoint, there's inflationary pressure, especially in the developed economies. And there are also political uncertainty and geopolitical situations that are playing around. And those are obviously headwinds that, that one has to keep in mind. Having said that, where we sit today, there are also significant tailwinds, especially if we look beyond IT and ITES as sectors. So if we look at what's happening in the retail environment, if we look at what's happening in the auto sectors, there's a fair amount of trends on revenge buying, on revenge travel. There's a lot of capex expenditure, both projected and already being done by federal and by public and private players. So I think at this point in time, as we see it, tailwinds certainly are taking the lead as compared to headwinds. But yes, no one could have projected what happened in 2020. And if similar black swan events happen again, where political risk or political uncertainty escalates to a degree where it starts impacting everything, then obviously companies will move into BCP planning mode. Companies will have to really revise and start looking at the short term. So unless we're talking about black swan events, we don't see this situation changing a couple of months down the line. All of these numbers, when we say projected numbers, these are companies are also aware and are carefully watching the situation and have given these numbers, keeping those situations in mind. Given the fact that the war for talent is still on, almost everyone has been talking about supply side pressures on talent. The fact that we are actually seeing a moderation from where we were in 2020, from 10.6% to 10.4%, is testament to the fact that there is a realization across the board that there are potential risks also in the market today.
Yes, and some of those risks at this point in time, we will wait to have to see how they play out. And of course, interest rates moving higher across the world, including here in India, and the impact on demand yet to be seen. But let me ask you about what I found interesting. E-commerce and startups, both sectors are likely to give out the highest increments in 2023 as per what your survey is telling us. But if you talk to people and you see what the data is telling us, especially with startups at this point in time, valuations are seeing drastic cuts. Funding has dried up to a large extent. We're also seeing people either lay off or shut down altogether. So, again, I'm sensing a little bit more optimism in the survey than we are getting from the ground at this point in time.
Sure, Rola, I think that's a very, very valid point. But the fact is, if we actually now look at startups, they are a very heterogeneous bunch. You have, organizations who are probably seed funded or Series A, B, and then you have organizations that are C and D and E and beyond, and all of them getting clubbed under startups. I think if we actually observe what is happening on the e-commerce and the startup front, there are 2 or 3 things that stand out clearly. One, for organizations that have a proven business model, there isn't a funding challenge. All of them have runway right up till the next few quarters from a cash perspective. Of course, when we look at organizations or when we look at startups, they've had to scale down the experiments that they do, or in areas where they have had to revisit their growth plans, which are fairly ambitious. But for proven business models, whenever we speak to VC funds, they're already vested to a fair degree. Yes, valuations are not as high as 2022, or rather 2022 beginning in 2021. Term sheets are not getting signed in a couple of days. But there is investment available, because if you look at structurally, the India market continues to be a market which promises high returns. Having said that, I think where this ties back to the survey is that startups don't have the luxury of building talent ground up. Given the hyper growth journeys that they are in, they have to continuously invest in in talent to a degree where other sectors don't probably have to, and essentially they have to continuously buy their talent from the market. And also from an employee perspective, when they are looking at joining startups, one of the clear value proposition is around the higher salary increments, faster career growth, maybe wealth generation through equity. and which is where historically as well, startups have tended to be fairly good paymasters, and even in the kind of salary increases that we see in startups and e-commerce, they are on the higher end. The only cautionary note here is that from 2022, the projected numbers here are also down by almost a percentage point, which again reflects the fact that yes, there is a realization around responsible growth that even startups are looking at, and they have a keen eye on the cash that they're burning, especially on employee salaries and other input costs.
Yeah, and as you point out, we've already seen a little bit of that correction happen over the last 12 months between last year's survey, the actual performance, and the projections that you've put out in this year's survey. Let me end then by asking about the war of talent, which you spoke of. And attrition has been sky high, 20% plus, especially for sectors like the IT sector. Some degree of stability likely to return as far as attrition is concerned, and specifically on the way that comp is structured now, any changes expected, given the volatility that companies are going to be mindful of?
Sure. So I think on the attrition front, yes, we have seen early signs of the intense war for talent subsiding to a degree. From a 2021 perspective, that number stood at 21%. And the 2022 YTD number is slightly down at 20.3%. A lot of this 20.3% again is driven by IT and allied and adjacent sectors. The challenge for this sector is that while we, from a business perspective, we classify it as IT, frankly, the talent that they house is something that even auto, manufacturing, life sciences, everyone is really going after. And which is where, because of the convergence and because they are essentially the talent catchment areas when it comes to digital skill sets, for them, at least on the tech side, the war for talent continues to be there. Having said that, I think we are seeing early signs of moderation in a large number of pockets. Growth hiring is reducing, and largely companies are now focusing on replacement hiring. So yes, I think as we go forward into 2023, there is a possibility that this number may fall below 20%, but we don't foresee it going back to pre-pandemic levels where 15% used to be the industry norm. So to that effect, I think the demand for digital talent will continue to be there as the other sectors mature. But yes, to a fair degree, this number might moderate.
Any changes as far as comp structure that you're picking up on?
Yes, I think interestingly, when we look at the way comp is structured and their pay mixes are playing out, while salary increases are seeing similar increases as we've seen in 2022, on the other hand, when we look at bonuses, and bonus is essentially linked to the profitability of a firm. Now, with all of this spending on talent and the fact that not every industry can transfer these costs to the end customer, across the board, we are seeing fair amount of margin pressure. And that margin pressure eventually will mean that across the board, bonuses might take a hit. So in 2022, against a target bonus, you saw 1.1, 1.2x payout. In 2023, that is likely to be the one area where you will see a cut down, where you might not see the entire bonus getting paid out. So when we look at salary structures, I think, yes, definitely bonuses are one place where then the employee might feel a pinch, even though the salary increase numbers look to be fairly buoyant.
Well, Jung Bahadur Singh, we'll leave it there. Thanks very much for joining us here on Business 360 to take us through the highlights of the on salary survey. A little over 10% is the expected hike in 2023 as per your projection. And, well, employees are certainly hoping that it will stay the course. With that, it is time for us to wrap up this edition of Business 360. Thanks very much for watching. Stay tuned to CNBC-TV18. The news continues when we return.